Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. Thank you so much for joining. If you have questions or topics that you'd like to discuss, please chat that over now so that we can be sure to get to them all. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. I can see we've already got a question that's been chatted up by Nick. Thank you for bringing the question, Nick. We're going to start out with your question. Just to first preview it, though, this is another Solo 401k daily webinar. This is our second one of today. We have these daily webinar and Q&A sessions. You can always join at mysolo401k.net/webinar. Sign up. You'll get an email with a link. And if you can't make it live, you also get a link to the recording. You can also subscribe to us on different platforms, on YouTube, on X, on LinkedIn, Instagram. That way you get notifications of the content that we bring every single day. You can come and ask questions live, just hear what we want to share. If this information is helping you feel more confident about your future as we go through the slides, please like this video, as it's going to help us to get the word out to other entrepreneurs, other solopreneurs like yourself, other advisors who might themselves be needing this important information. Today's topic is the Fidelity Solo 401k blueprint, how to shelter $83,250 in 2026. Now, before we turn to that good content, let's first field this question from Nick. My question is if I'm needing to file my 5500 because I'm over the $250,000 threshold, does it make a difference to the IRS if I use my LLC EIN or sole proprietor EIN? The work I do through both my LLC and sole proprietorship is exactly the same. And when I file my individual tax return, I make no distinction between the two in terms of filing earnings, but I'm unsure of the implications with regard to the solo 401k. So you definitely cannot use your social security number. You have to use an EIN number. Now, if you've got multiple EIN numbers because you've got different sources of self-employment income, you can aggregate from all sources for purposes of making contributions. In terms of filing the 5500 EZ, you'll want to use the name and EIN number of the business that's listed on the plan documents. So if the LLC, for example, is listed on the plan documents, that's the name and EIN number that'll be used. Now, note for our customers, we do prepare the 5500 EZ, including via the electronic filing system, so it can be filed electronically as part of our service for no additional charge. Customers or their advisors just have to let us know once the value exceeds $250,000 so we can add them to the queue to take them through the 5500 EZ filing process, where again, it gets filed electronically. All right, so now let's go to the next question from Jonathan. Thanks for bringing it. And again, if there are questions or topics that you wish to discuss, please chat that over now so that we can be sure to get to it. After this next question from Jonathan, we'll go through some slides, but we've got plenty of time to field more questions. I want to make sure the solo 401k is for me. I have a W-2 job where I max out my 401k contribution. I also do the max IRA Roth conversion every year. Last year, I've started getting revenue against 1099 and multiple LLCs in which I'm sole owners. How much can I max for my solo 401k? If my wife has her own 1099 income, can she also max? So that's wonderful, Jonathan. Thank you so much for bringing the good questions. Now, the threshold issue for anyone who's looking to set up a solo 401k is that you have to be eligible. So there's two pieces to the eligibility equation. Number one, you have to be reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by the individual or a spouse, if any. So first piece is you got to report that earned self-employment income. So that can be from multiple sources, right? If you're a serial entrepreneur, that's fine. You can aggregate from all sources. Moreover, if your spouse is working with you and you're both reporting your own earned self-employment income from the same business, you could set up one solo 401k plan and both participate in it. The fact that you've got a W-2 job is not going to prevent that individual. So if you've got a side hustle or multiple side hustles and a W-2 job, you can set up a solo 401k as long as you also don't have any non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. So that's the second piece of the eligibility equation. So as far as being able to max out the Roth IRA conversion every year, that is true. Making Roth IRA contributions is not going to count towards the solo 401k contribution limit. Now, as far as how much you can max, well, if you've got 2025 earned self-employment income and your business is taxed as a sole proprietorship and you don't have any full-time W-2 employees working for any business owned by you or a spouse, if any, you could still set up a solo 401k for 2025. And you could even make all types of contributions for 2025. Again, if you're a sole proprietor, based on that sole proprietor income. Now, you'd have to make the employee contributions for 2025 by April 15th of 2026. So you'd have to set up the plan and the accounts and determine how much you're going to contribute and make that employee contribution. Now, if you file the timely extension for your 2025 1040, you could get more time. That would automatically give you more time to make the employer and the voluntary after-tax contributions for 2025 by your extended business tax return deadline. So October 15th, if you file that timely extension for that 2025 1040. Now, if your business is not taxed as a sole proprietorship, let's say it's an S Corp, you could still set up a plan for 2025 and make 2025 contributions, but it would be more limited as compared to the sole proprietorship. So for an S Corp or another non-sole proprietorship business, it would be too late to set up a plan and make 2025 employee contributions, but you could still set up a plan to make 2025 employer and or voluntary after-tax contributions. Now, as far as the overall limit, for 2025, the overall limit is $70,000 or an additional catch-up contribution amount based on whether or not if you're age 50 or older, in which case it would be another $7,500 for 2025. Again, that assumes that your business is taxed as a sole proprietorship because a catch-up contribution is a type of employee contribution, or an additional $11,250 if you're age 60 to 63 during 2025. Now, for 2026, as we'll talk about as we go through the blueprint here, the limits increased to $72,000 is the overall limit for 2026. The catch-up contribution limit increased to $8,000, and the super catch-up, which applies to those who are age 60 to 63 during 2026, instead of $8,000, that's $11,250. So that's how you could potentially get up to $83,250 for 2026, and that's per person. So if there's a couple, say two spouses, they each potentially could contribute that much if they have the earned self-employment income to justify it, and if they're age 60 to 63. But even if they're not age 60 to 63, they can still get a pretty relatively high amount. Even if you're under 50, you could go all the way up to $72,000 each for 2026 if you've got that earned self-employment income to justify the contribution. All right, hopefully that helps, Jonathan. Let us know if there's more questions, but let's go through some of these slides we wanted to share around the blueprint for Fidelity. And as you'll see, that also includes the ability to access tax credits, $1,500 in tax credits. Now, the foundation is eligibility. And as we talked about with Jonathan's good question, there's two elements to the eligibility equation. Number one, you've got to be self-employed. So a solo 401k fundamentally is an owner-only plan. It's also referred to as a one-participant plan. Now, there are exceptions to that one-participant requirement, like a spouse who's working in the business or another business owner, as long as they're at least 3% business owner, and as long as the spouse or business owner are reporting their own earned self-employment income. But so you got to have that earned self-employment income, and you cannot have any non-owner, non-spouse, full-time W-2 employees. Now, earned self-employment income can come in different forms. So, for example, you don't have to have a formal legal entity. Like we talked about with Jonathan, you could be a sole proprietorship. That means you don't have a formal legal entity. Or you could have an entity. You could have an LLC tax as a sole proprietorship. You could have an S Corp. You could have a C Corp. You could have a partnership. Ultimately, the key is not whether you've got a formal legal entity, but the key is that you report earned self-employment income. So for a business tax as a sole proprietorship, could be somebody that doesn't have a formal legal entity, or maybe they do have a single member LLC that's taxed as a sole proprietorship. Earned self-employment income is income reported on line 31 of Schedule C. If the business is taxed as an S Corp or a C Corp, earned self-employment income would be the W-2 wages that you receive from the S Corp or the C Corp. Whereas if the business is taxed as a partnership, earned self-employment income is income reported on line 14 of the K-1 that you receive from the partnership. Ultimately, the way that I think about it is that a 401k is for people who work, and a solo 401k is for self-employed people who report earned self-employment income. So it's not somebody that just has investment income, somebody that just is making money off of money that they already had, investment income. It's really based off of earned income. Now, there's no minimum amount of earned self-employment income that you would need in order to be eligible to set up a solo 401k. In other words, a solo 401k is not just for a big solopreneur business. It could be for a micro solopreneur business. Could be for a side hustle. So you can have a solo 401k even if you've got a W-2 day job, even if you participate in your W-2 employer-sponsored plan. And as we learned with Jonathan's good question, your spouse could also participate as long as the spouse is also working in the business and reporting their own earned self-employment income. So let's feel Jonathan's follow-up. He said, so for my wife, for her to be extension of my solo 401k, she needs to work for my business. What if she has her own business? Exactly. She would need her own plan. So let's say you got one spouse as a realtor, the other spouse is an attorney, and their businesses are totally separate. In that case, it would be separate plans for each business. Wonderful. So now let's talk about how Fidelity fits into the equation. So to understand this, I think it's going to be helpful to understand that a 401k plan is really a legal entity. It's technically a retirement trust. So like any legal entity, it's the documents that create it. So when someone puts assets in a 401k plan, they're held in trust for the benefit of the employees when they're retired. In other words, it's not an asset of the business. It's not even an asset of the retiree, of the participant, that they can use without restriction. It's held in trust for their benefit when they're retired. So like any legal entity, it's the documents that create it. It's the documents that dictate what you can do. So yes, you could go and you could get a vanilla basic plan from Fidelity, but it's going to be basic. It's not going to allow you to do advanced features. They're not going to provide advanced support like my solo 401k financial does. But what's great about us is that our plan is totally portable. We're not invested in terms of where your accounts are at because we don't hold our customers' money. We don't provide accounts. We don't provide investment accounts. So we're totally neutral as far as where the accounts are at. Now, at the same time, we care, right? We want to make sure that the accounts are set up correctly. We're very hands-on in helping customers open up the accounts to make it easy. And Fidelity happens to be the top brokerage choice for our customers. So we've helped thousands and thousands of customers open up accounts at Fidelity. So you can certainly use Fidelity for the accounts, for the assets, right? Hold your brokerage accounts there with the brokerage type investments like stocks, bonds, mutual funds. But my solo 401k financial provides the plan. So that dictates what you can do. So now you can do all the advanced features that drive customers and their advisors to set up accounts with us, such as, for example, the ability to make mega backdoor Roth contributions. So if you get Fidelity's basic plan, it's not going to allow for mega backdoor Roth contributions. It's not going to allow you to take a 401k participant loan. It doesn't allow you to claim $1,500 in solo 401k tax credits. So my solo 401k financial, we were the first provider to offer a solo 401k plan that's eligible for the mega backdoor Roth contributions. We were the first provider to offer a plan that supports the $1,500 in tax credits. So you can get all that history, all that support, all that knowledge, but still have your accounts where you want, such as Fidelity. So you get the plan documents from us, but have the accounts at Fidelity. So that's how it works. And again, we're very hands-on in helping you open up those accounts at Fidelity. By the way, those accounts at Fidelity are free accounts. Fidelity doesn't charge anything to open the accounts. There's no maintenance fee. Now, for 2026, like we talked about with the good questions that kicked us off, the contribution limits are higher than ever, right? It can go all the way up to $83,250. It goes up because of inflation, right? The theory is you'll need to save more because you'll need more. So what are those 2026 solo 401k contribution limits? Well, a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. So this is way higher than the 401k contribution limits that you might have at a day job corporate plan. Why is that? Well, when you work in a day job corporate plan, you only get to fill up one bucket, the employee bucket. But when you're self-employed, you're both the employee and the employer. In addition, if you've got a solo 401k plan like the one offered by my solo 401k financial, you can also make a third type of contribution, which is called a voluntary after-tax contribution. That's how individuals make mega backdoor Roth contributions. So the employee limit for 2026 is $24,500. It increased from $23,500 in 2025 to now $24,500. The catch-up contribution limit, so once you're age 50 or older, the rules allow you to make even additional contributions if you've got the earned self-employment income to justify the contribution. So if you're age 50 plus, now you got access to the standard catch-up contribution, which increased from $7,500 to now $8,000 in 2026. And in addition, if you're age 60 to 63, you can make an enhanced catch-up with what's referred to as a super catch-up contribution. So instead of $8,000, you can actually contribute an additional $11,250. And then the overall limit is $72,000. So that's how you can get all the way up to $83,250. Now, as I mentioned, a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can fill up different buckets. So the employee bucket, that's the elective deferral plus the catch-up if those apply. You've also got the employer bucket. Now, the employee bucket, that's 100%. So you can contribute 100% of your earned income, earned self-employment income dollar for dollar up to the applicable limit. Whereas the employer bucket, that's a percentage of your self-employment compensation. And the percentage that applies depends on how your self-employed business is taxed. So for example, if your business is taxed as an S Corp or a C Corp, your ability to contribute is based off of the W-2 wages that you receive from the S Corp or the C Corp. Remember, it's based off of the earned income. So it's based off of the W-2 wages. So that employer contribution limit is 25% of the W-2 wages. Whereas if the business is taxed as, say, a sole prop or a partnership or an LLC taxed as a sole prop, you have to run a pre-calculation. And we help our customers to run this pre-calculation. There's even a calculator on our website where you take your net income. So for example, your net income on line 31 of Schedule C, if your business is taxed as a sole prop, or your net income on line 14 of the K1 that you receive from the partnership that files a 1065. You start with that net income, then you reduce it by 1/2 of the self-employment tax. That gives you the self-employment compensation figure. So of that amount, you can contribute 20% as an employer contribution. Now, of course, you've got to keep in mind the overall limit. So the sum of all the contributions that you make to the plan, the employee, the employer, and the voluntary after tax cannot exceed the overall limit, which is $72,000. Or if you're eligible to make those catch-ups, that doesn't count towards the $72,000, and you can make above and beyond that. And that's, again, how you can get all the way up potentially to $83,250 for 2026. And again, the accounts can be at Fidelity. So you're not making the contributions to my solo 401k. You're not sending us the money. It's going directly to the Fidelity accounts that we would help you set up, that only you would have access to. So the employee contributions, just to dig a little deeper into each of the different buckets, again, it's now up to $24,500 for 2026. Now that can be contributed either as a pre-tax or a Roth, or it can be a mixture. Of course, again, you can't save more than you earn, so it's going to be limited by your earned income if it's less than $24,500. It's also noteworthy that that employee bucket, that limit applies at the employee level. So remember, we talked about how you can't have a W-2 job and then set up a solo 401k for your side hustle. You can even be contributing to your day job 401k plan. But if you max out the employee contribution to your day job plan, you're not going to be able to make any more employee contributions to the solo 401k because that employee limit applies at the employee level. And again, it's going to count towards the $72,000 overall limit. Catch-up contributions, that's another type of employee contribution, but it's an additional amount that could be contributed. So again, 100% dollar for dollar of your earned self-employment income. Now you could go up to an additional $8,000 if you're age 50 plus, or instead of $8,000, it could be $11,250. Now, when we say must be Roth per Secure Act rules, that only applies if you've got income above a certain amount, $150,000, for example, for 2026, specifically income that's paid to you as W-2 wages. So if your business is taxed as a sole prop and you don't get W-2 wages, then that wouldn't even apply. So we're going to just qualify that. If W-2 wages over applicable amount. Okay, just to be really clear, we don't miss that. So, but that's going to be on top of the 72,000, right? So the overall limit effectively goes up. Now, employer contributions, unlike the employee contributions, where that employee limit applies across all the plans that the employee participates in, and you can only fill it up one time, the employer contribution limit applies at the plan level. That's why your employer doesn't have to ask you if you have a 401k plan somewhere else. They can make an employer contribution, and they don't have to determine if other employer contributions are being made to another plan, right? It applies at the plan level. So even if you max out contributions to your day job plan, even if your employer also makes contributions on your behalf, like if you get a matching contribution to your day job 401k plan, that's not going to reduce your ability to make contributions to the solo 401k. Because again, the employer contribution limit applies at the plan level. Now, the one exception to that general rule is the 403b exception. So if contributions are being made to a 403b either by you or on your behalf, all of those 403b contributions, whether by you or on your behalf, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. Now, as we talked about, the employer contribution limit, unlike the employee limit, which you can contribute 100% of your self-employment income dollar for dollar up to the applicable employee limit, the employer contribution limit is a percentage. So for a sole prop, it's 20% of your self-employment compensation. So you specifically have to run that pre-calculation where you take line 31 of Schedule C less 1/2 of the self-employment tax. So we're going to say just to be really clear, 20% of self-employment compensation, line 31, less 1/2 of self-employment tax. Now, if your business is taxed as an S Corp or a C Corp, it's going to be 25% of the W-2 wages that you receive from the S Corp or the C Corp. Now, specifically, you would have to take box 1 of the W-2 plus any pre-tax elected deferrals that are not in box 1. So if you had made employee contributions as pre-tax contributions, then that would have reduced box 1. So it's determining 25% of your W-2 wages. You add back those pre-tax elected deferrals not in box 1 and now over in box 12, and then the sum, box 1 plus any pre-tax elected deferrals not in box 1 over in box 12 times 25%, and that's how much you can contribute as an employer contribution. Now, of course, the sum cannot exceed the overall limit, right? We talked about that. The sum of employee, employer, and voluntary after-tax cannot exceed the overall limit. Now, the employer contributions, they can be either pre-tax or Roth. And of course, our plan allows for that, both pre-tax or Roth. But really, based on experience, many of our customers, they're not interested in making employer Roth contributions. Even though that was something that some people got excited about after the Secure Act allowed for employer Roth contributions, it was really not a big deal for our customers because they already had the ability to make mega backdoor Roth contributions. So for those that are really looking to maximize the funds that end up in a Roth account, in our experience, they would typically just skip making employer contributions because it's discretionary. You don't have to make employer contributions, and you could just go right to the voluntary after-tax contributions. So the voluntary after-tax contributions, that's how you make mega backdoor Roth solo 401k contributions. So really a mega backdoor Roth solo 401k contribution is a two-step process. The first step is making a voluntary after-tax contribution. And so you can contribute 100% dollar for dollar of your earned self-employment income as a voluntary after-tax contribution. So unlike the employer contribution, where it's just a percentage of your earned self-employment income, you can do 100% of your, say, W-2 wages that you receive from your S Corp, dollar for dollar, up to the overall limit, which is $72,000 now for 2026 as a voluntary after-tax contribution. Of course, you have to have a plan like the one offered by my Solo 401k Financial that allows you to make those after-tax contributions. And then you'd have to have a plan like the one offered by my Solo 401k Financial that allows you to then transfer those after-tax Solo 401k funds over to a Roth Solo 401k or a Roth IRA. And again, we were the first Solo 401k provider to offer a plan that allows us. We've got the most experience. No one has more in helping customers through these mega backdoor Roth contributions. We also provide tremendous support in terms of the mechanics, right? Like opening up the different accounts. We also provide the ongoing compliance support for no additional charge. So even though that first step, when you make the after-tax contribution, that does not need to be reported on the personal tax return or the business tax return. The second step, when you move the funds over to the Roth, that does need to be reported on a 1099-R, and we'll issue that 1099-R for no additional charge. Customers or their advisors just have to let us know after that after-tax to Roth transfer so we can add it to our queue to prepare the 1099-R. Now, it's noteworthy that, yes, you could take a waterfall approach where you first fill up the employee, then the employer, then you get to the after-tax, or you could skip it and you could just go right to the after-tax. So you've got the option. You could skip employee, you could skip employer, and just go 100% after-tax. So let's make that crystal clear. So you could do or 100% voluntary after tax. So let's give some examples with some meat on the bone. So we've got an employee age 60 to 63 for 2026. They make $24,500 employee. They make $20,000 employer. They do a voluntary after-tax contribution of $27,500. And then on top of that, they do an $11,250 catch-up contribution. So they've contributed And this, of course, assumes they got the income to justify it, but they've contributed $83,250 to their solo 401k. If their W-2 wages from their business taxed as an S corp, for example, is $83,250, they could do this exact contribution amount, assuming they don't make any employee contributions to another plan, like a day job plan. Now, let's assume that instead of 60 to 63, they're age 55. They could do $80,000 for 2026, assuming they've got the income to justify it. So here in this example, they would need, if their wages are $88,000, because it have to be 4 times 22 to justify that $22,000 employer contribution, they could do $80,000. They could do this exact scenario, $24,500 employee, again, assuming they don't make contributions to another plan like a day job plan, 25% of their W-2 wages as an employer, that's another $22,000, voluntary after-tax contributions of $25,500, plus an additional $8,000 as a catch-up contribution. And again, the catch-up contribution, that would go directly to a pre-tax or a Roth. It wouldn't go into the after-tax bucket, but then they can move the after-tax bucket. They can move those after-tax funds as that second step from the after-tax account over to the Roth account as part of that mega backdoor Roth strategy. So key takeaways, the $72,000 limit, the overall limit for 2026, that applies to employee, employer, and after-tax. Catch-up contributions get you above that if you're age 50 plus, either the standard catch-up or the super catch-up. Mega backdoor Roth, you've got to have a plan that allows for the voluntary after-tax contributions and then that subsequent transfer to the Roth, either the Roth 401k or Roth IRA. So you need to have the correct plan design to unlock this full $83,250 strategy, which of course we offer the plan that allows you to unlock it, and you can have your accounts at Fidelity, because again, we're totally neutral as far as where the accounts are at. Fidelity is the most popular brokerage where our customers are opening up accounts. All right, thanks for letting us run through that. So let's go back to the questions. But before we do, please like this video, as it helps us get the word out to other solopreneurs like yourself that might need the information. They might be trying to catch up on their retirement accounts, or maybe if you're another advisor, if you're an advisor, help us get the word out. We also invite you to subscribe so you get notifications of when we go live, because we do go live every single day. That way you get notifications of the content. You can come and ask questions or just check out what we're sharing on a daily basis. So please engage with us on LinkedIn, YouTube, X, Instagram, the different platforms. So let's go back to Jonathan. What is the difference between Roth IRA or Roth 401k? Well, in the context of a mega backdoor Roth, you got options. Remember, you have to have a plan like the one offered by my Solo 401k Financial that allows you to transfer, that allows you to first make the after-tax contribution, that allows you to take advantage of the higher after-tax contribution limits, because again, you can go 100% dollar for dollar to the overall limit as an after-tax contribution, and then transfer either to a Roth Solo 401k or a Roth IRA. So you got options. You can do either. Either case is going to be reportable on 1099-R, but my Solo 401k Financial, we handle the 1099-R for no additional charge. Customers, their advisors have to let us know when you do the transfer so we can capture the information. Now, as far as why go to one versus the other, if you want to keep the ability to invest in alternative investments, if you want to keep the ability to take a 401k loan, then most would choose to keep it in the Solo 401k. You'd have to keep it in the Solo 401k if you want to be able to keep the ability to take a 401k loan, because you can't take a loan from a Roth IRA. Now, theoretically, you could transfer to a Roth IRA and invest in alternative investments. Alternative investments like crypto, real estate, private stock, pre-IPO stock. These are the things that our customers are investing in. You could theoretically do that with a Roth IRA, but our plan already allows for it. And that would be a Roth IRA, a specialty Roth IRA, where it's going to be another provider. They're going to have their own fees. They're going to hold the money. So for customers that want to invest in alternative investments, they've already got the tool to do that via the Roth Solo 401k. So that would be a reason. Some people might say, well, I'm happy with my Roth IRA performance. I want to just accumulate more dollars in that account. So let me just transfer these after-tax Solo 401k funds over to my Roth IRA. And that's totally fine too. You can do both. Keep in mind, you can't subsequently transfer it back, though, from the Roth IRA to the solo 401k, just because those Roth IRA rules wouldn't allow you to do it. So if you go to our website, mysolo401k.net, and then just click on under solo 401k, click on open account, and you can see the pricing linked right in there. I'm going to also grab a link as well just to help highlight it. We charge a totally flat fee of $650. That's the initial cost. That includes the $525 establishment fee plus the first $125 annual fee. Starting 12 months later, we charge our $125 annual fee that covers the second year. So it's totally flat, regardless of the value, regardless of that solo 401k support needed. So you know exactly what you're signing up for. Moreover, our solo 401k plan is going to enable the solopreneur, whether you're setting up a new plan or even if you're upgrading a basic plan. Let's say you have a basic solo 401k at Fidelity, but now you're realizing that it doesn't allow you to do what you want to do, like the mega backdoor Roth. You can upgrade to our plan. Upgrading to our plan will also enable you to claim the tax credits. So that's $500 of tax credits per year for 3 consecutive years for a total of $1,500. Tax credits, not tax deductions. So it's a dollar for dollar reduction in your tax liability, which is going to more than offset our fees for the first 7 years. Because even if you added up all of our fees for the first 7 years, it wouldn't amount to $1,500. So I chatted over the pricing page. On 50 plus, if I do $8,000 catch up on my W-2, would I still be able to do catch up on the solo 401k? No, because that's the employee contribution bucket. So you can only make the catch up to one plan. So if you make it to your day job 401k plan, you can't turn around and make it to the solo 401k also, though. In terms of employee or employer contributions, if they're both pre-tax contributions, they're both going to the same account. So ultimately, the self-employed person is both the employee and the employer. So they're ultimately going to reap the income tax deduction benefit one way or another. So for practical purposes, there's really not significant differences. I have a question on the Form 5558 for 2024. Do you combine regular solo with solo 401k Roth? So the Form 5558 is to get an extension to file the 5500 EZ. So I'm assuming you mean the 5500 EZ. So you'd need to combine the total solo 401k assets. So all the different sub-accounts, pre-tax, Roth, etc., all the different investments. And if the value of the plan, you even have to add the value of any defined benefit plan that might be sponsored by the self-employed individual. If the total value exceeds $250,000, then that 5500 EZ filing requirement would apply. And the snapshot is as of December 31st. So as of December 31st, 2024, etc. Yes, we've got plenty of clients that have used interactive brokers. Again, we're totally neutral. Fidelity's just happens to be the most popular, but there's a lot of other great options like Schwab, interactive brokers. Clients are opening up accounts at E-Trade, et cetera, et cetera. Can I roll over a previous employer plan? Most definitely. So that's super common. We've helped customers open up accounts at many different places. We've helped customers roll over funds from hundreds of different providers, right? Different former employer plan providers, different IRAs. And we've tracked that experience in our knowledge base so we can leverage that knowledge and experience to make it easy for new customers or existing customers that want to roll over money from like a former employer plan. Now, typically those funds will transfer by check. And so the check is mailed to you. It's made payable to the 401k. Then you take the check and deposit it into the 401k account. We would be hands-on in helping you. Again, leveraging our experience, maybe filling out paperwork if they have paperwork that needs to be filled out, just to make sure that it's communicated to the provider that this is a non-taxable rollover because you're rolling over the money to your new employer plan. So the best strategy is you want to make sure you file under the late filing program. The last thing you want to do is just submit it and hope for the best, because the IRS computer will eventually catch that, and then you'll get tagged with some expensive late filing fees. So the penalties are $250 per day. But they do have a late filing program where it caps it at $500. So, and the IRS does a decent job of explaining how to file it. I just chatted over a link to the procedure. So that's really the best thing to do, is to follow those procedures, pay the fee to file under the late filing program, and cap out those, and avoid the late filing fees. Yes, we do. Now, we submit the 1099-R for those that let us know about information, about transfers, for example, after tax to Roth transfers in a timely fashion. 5500 EZ, customers and their advisors just have to let us know once the value exceeds $250,000. Then we'll add you to our 5500 EZ filing process. So that's where we guide you through the 5500 EZ process. Now, we don't have all this financial information, so we send you a questionnaire to capture the financial information. Then we tee it up in the electronic filing system, what they call the EFAS system. Then we assign it to you for signature. You just have to log in, sign it, comes back to us as being signed, then we submit it and send you a courtesy copy. And again, no additional charge for those services. Well, fantastic. It looks like that's taken us to the end of the questions for today. That's some great participation. We really appreciate it. Again, if this is helping you feel more confident, please take a moment to like the video just to help your fellow solopreneur find this information. That's it for today's Solo 401k session. We'll be back here tomorrow with another live Q&A session. Thank you so much for investing your time with us. Your time is valuable. Your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building the Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.